Welcome to the Landlady Listens. The podcast where we talk all things real estate, development, and the mindset it takes to build your dream life. Okay, hey guys, it's Landlady. I'm your host, Meg Hayden, real estate broker, new construction expert, and a believer in making big visions into a reality. So if you're ready to build it, dream it, and live it, let's dive in. Hey guys, it's Meg Hayden from the Landlady Listens. We are so excited about today's guest. We have Alex Wallace. He is going to talk to us about commercial lending, not just SBA, but also different kinds of commercial lending. So this is a show that you're not going to want to miss. I am your host, Meg Hayden. I am a real estate broker specializing in commercial and residential real estate in Rhode Island and Massachusetts. So without further ado, hey Alex, how are
Meg.
you?
I'm doing
What's
very
going
well.
on?
Thank you for having me.
Of course. Tell us a little bit about yourself.
Sure. So I have been doing commercial lending now it'll be 9 years in August. I am a second generation mortgage broker. I've been doing this with my father, Bill Wallace. He's been in the industry for a while.
Forever.
So I learned a lot from him. I learned a lot directly working with the lenders. Like early on, I would sit down with vice presidents of banks. They'd show me the ropes, show me how I would have to process loans. And we've been learning, I learn more every year. And with every product that we pick up, learn more ins and outs of lending.
I'm sure there's every time it's always different. I mean, in real estate, I feel like it's the same process, but there's always something a little bit different that you end up learning with each different person. I'm sure every loan is different.
Yeah, especially, between the property somebody is buying, the industry that they're in, any inherent nuances to the property, whether somebody's going for something industrial, that's going to be a lot different than if somebody's buying a restaurant, or if somebody's buying a restaurant, was that restaurant formerly a mechanic shop that got converted over? So there are a lot of nuances, and every deal is its own entity. And we're always happy to help and see. I really like seeing the businesses grow. The first SBA loan that I did, like a true SBA loan, was for a coffee shop in my neighborhood. They went from being a food truck into a brick-and-mortar location. And that's one of the reasons I really like handling the business financing, because, it's one thing to do a loan when somebody, if they're buying investment property, you're not going to be able to walk into that property and see the person that you did the loan for and see how they've grown. But walking into their business and seeing just how much progress they've made and how far they've come. And I appreciate that I know that I did something to help with that. And that's something that I'm always grateful for that. I'm happy to be able to see people flourish.
Absolutely, because I feel like in this industry, for me, I really liked real estate because I like helping people. And I think that when you work with people like you guys, or whoever you partner with, that it is really important to always have that as kind of your foundation, where you are really taking care of people and making sure that it's really the right decision for them and you're helping them along the way. And I think specifically with commercial lending and businesses, you don't get a lot of help or hand holding necessarily. And so I think it's amazing that you guys are able to really help and support businesses kind of go from their dream to execution, and especially through real estate. So talk to me a little bit about, you were talking about businesses. Can we kind of talk about there's different lending, I would assume, for, real estate and business. And then are you lending on also business just without the real estate, or can you talk to us a little bit about those two options?
Yeah, so I would say, really, there's 3 different options, all of which are different forms of SBA financing. And SBA is the Small Business Administration. They're here government agency to help small businesses grow, to help local economies through job growth and just the growth of the businesses themselves. So we have the micro SBA loans, which are the smallest loan that we offer. That's a $50,000 loan that could be used, instead of somebody having to use credit cards, they can have this chunk of money that they have access to. It's also unsecured because that's the only SBA loan that's not secured.
What does that mean?
So they are not putting a lien on anything. It's not going to be so. With SBA financing, you have, other than the micro SBA loan, and I'm sure there are other products too, but these are the big three that we deal with. So we have the micro SBA loan, which is, could look at it as working capital for hiring people on, for advertisement, or just generally a small business that, they've been in business a few years and they're really trying to jump into their next step. And that can help to allow that.
Mm-hmm.
Then you have a 7A where that is a secured loan. They're going to put a lien on some sort of property. They're
Right.
going to put a lien on all business assets. And then depending on the size of the loan, they're most likely going to put a lien on the real estate. So that's why it's a secured loan, because they need to collateralize it, just like any other sort of financing. They're going to want collateral. So with a 7A, if there isn't enough assets with the business itself, they could end up putting a lien on a home. So they
Mm-hmm.
put a second possession lien on home,
Mm-hmm.
investment, real estate. It really depends on what the borrower is doing.
Or what they have, right?
Yeah, and then
What
there's
collateral is available.
exactly, and it is an SBA guideline that they have to go after whatever collateral that they can.
Mm-hmm.
Then there's the SBA 504, which that is for a business to buy real estate for itself. That's what we've been doing a lot more now, where we aren't seeing as many people buying investment property, or not as busy as we were in the past on that front. There are a lot more businesses who have been growing, and they're trying to buy a location for themselves, be it the location that they currently occupy.
Mm-hmm.
It could be, just another property that's within the footprint of where they are currently, or they could be buying a whole nother location. They could be expanding. They could be going into like industries. And that's collateralized by the real estate itself. The 504 is a lot more appealing for bank financing when a business is approaching a bank for financing, because a bank's biggest fear is risk. And there's virtually no risk for an SBA loan for a bank because they're only in there at 50% loan to value. The SBA goes in depending on.
Can you explain that?
So when the bank is when somebody's borrowing money from the bank,
Mm-hmm.
they have to apply for the financing. They have to get everything done, and the bank is the worst case scenario a bank looks at is that they're going to have to foreclose on the property. So if the bank is financing at, say, 75% loan to value, that means that the borrower has put down 25%,
Mm-hmm.
and the bank is lending 75% of the value of that property. With an SBA 504 loan, SBA, if, say, somebody got in at 10% down, SBA is financing 40% of that purchase price, and they're going to be in second position, and there's a guarantee. So if the borrower was to default, that 40% is covered by SBA. So the bank is only on the line for 50% of the value of the property. So they know if they have to sell that property, they're going to get their money back. Restaurants are an industry that banks notoriously do not like to lend on
Mm-hmm.
because of how risky
Right.
restaurants can be.
Mm-hmm.
So when they have that SBA guarantee and a well-experienced and well-qualified borrower, they're going to be a lot more comfortable lending the money on that. SBA loans do take a bit longer to close. They are a bit arduous. I try to make it as easy as possible on the client. But I always say anytime if somebody is getting SBA financing, they're going to be asked a lot of questions. And when it seems like all questions could have been asked and answered,
There's one more.
there's always more. But I also say, it is a process to get through them. But once it's done and in the rearview mirror, ultimately that business is in a property that they own.
Yeah.
They're not paying rent.
No.
And all of that process is in the past. And they're able to focus on the future.
Yeah, I literally just had a conversation with somebody who owns a karate space, and I was telling her, I'm like, again, you're like leasing out a space and you're paying somebody else's everything, right? Because typically in a commercial lease, the tenant is responsible for pretty much everything.
Hmm.
It's not like a residential home where, if the heat goes, you call the landlord. It's like, no, if the heat goes, like, it's depending on the way the lease is structured, but most of the time the big ticket items are part of what you're supposed to maintain as the tenant. And I'm like, especially if you're a business owner and you're spending all like this time and energy in making this business happen, it's so important to leverage the real estate, especially if you're and commercial real estate, I don't it's not as expensive, I think, as you would imagine. Especially now, I feel like commercial real estate is in some parts it's a little bit slower.
Hmm.
But I don't think a lot of businesses even like think about the real estate necessarily to say like, oh, I could afford this, I could do this. Um and then with an SBA loan, correct me if I'm wrong, but you can take a property, rent out part of it. But it's like 50, you have to have
You have to occupy
51%.
51% of that property.
Right, which is still great. So you're buying like a duplex, right? So I feel like, I was telling this woman, I was like, listen, like, you know, be the lady that owns the real estate. That's something that like you'll be able to give to your kids. It will be like of value, because a
Hmm.
lot of the times the businesses aren't necessarily of value if people don't want to take it over, right?
Yeah.
And so the real estate, that's a forever thing,
Hmm.
and they can rent it out and sell it or whatever. But it's something that is like of value. And obviously with the businesses, depending on what the business is, but there's a lot of businesses I've been reading like Cody Sanchez, and there's like a lot of transfer of wealth right now happening because a lot of the businesses that people that let's say a family has started, the kids don't want to take it on, right? Even if it's cash flowing a certain amount, they're just like, I'm not interested in the garbage industry or the plumbing industry or the flooring industry. So for like those, do you guys do like, so for SBA, can you get loans for like to purchase businesses that are cash flowing, or like how does that work if there's not necessarily like real estate attached to it? And that's going to be like my second question too, is kind of like, how do we separate like real estate with business and find the value in like
Hmm.
both of those?
So that would be where the 7A comes into play. The
Okay.
7A would be when there is no real estate involved.
Right.
And just where, if you were buying real estate, you would have an appraisal done. With a 7A, instead of having an appraisal done on the real estate, you're getting an evaluation done on the business.
Okay. And can you talk me a little bit through that process and what the cost is?
The cost of an
Relatively
evaluation,
speaking, yeah.
it's a few thousand. Like I would say it's probably not more than 5,500, but a ballpark figure, I would say probably between 35 and $5,500.
Okay. Can you get me some evaluators? Because I would love to have them on
Those
my
are
show.
ordered by the bank.
Those are ordered by the bank. So what are
So,
they called then?
what do you mean?
They're called like business
Business
evaluators.
evaluation or
I mean, they're
business,
like in
maybe
a
business appraisers.
business appraisers. Okay.
So I myself, like when an appraisal is done, I do not speak with the appraiser.
Yeah, it's like residential. Right.
So that's handled the bank, even in a bank. So a bank has an appraisal department. They engage the appraiser,
Mm-hmm.
and like we work with the vice presidents. They do not speak with the appraisers
Yeah,
themselves.
yeah. And that only happened because people were saying, "Oh, it's worth $1 million," and it was not worth
Yeah.
$1 million. Taking out loans, that's so crazy. Um, yeah, I wonder what even like in a business appraisal, there's obviously like equipment, right? There's like
Hmm.
potentially like equipment, cash flow, and I mean they're going to take into account like what are some of the other things
Those
that
are
they
really
take
the
into
big
account
two.
too.
Is they would be looking at what kind of equipment is involved in the transaction
Mm-hmm.
and with the business, and then how much business at that property and that business is actually doing, how much money is going through that business,
Mm-hmm.
and what's coming out from net profit,
Mm-hmm.
what's getting added back in, like depreciation or disbursements to the owner.
Mm-hmm. Okay. And interesting. And so then when you're looking at the equipment and the basically like the cash flow at the end of the day, so we're looking at that. And then when we're looking at the real estate, so are those like two separate loans, or are they one combined? Like how does that typically work when you're
So
doing the real estate and the business?
it depends on what there is for tangible assets.
Tell
So
us what's a tangible asset.
something that you can touch. So
Okay.
whether that be equipment, really
Hmm.
it would be equipment like furnishing. There is some value with the furnishing,
Yeah.
but the biggest thing would be equipment. Um, then there's also goodwill, which is not financed. Um,
What's goodwill?
so that would be where there isn't a dollar value assigned to something. There could be, you could be selling a business where you're buying the real estate, you're buying the equipment, and then there's also the goodwill, which is really what the people want to be able to walk away when they're selling their business. Like you could technically you can get financing for it through the 7A. But sometimes, somebody may not want to have to get a lien on their house because they need to spend $50,000 extra on the property, or on the business itself. So that would be if somebody was trying to avoid having to get a business evaluation done and they do have the money to pay for the goodwill out of pocket, then they
Mm-hmm.
can do that, or they could do seller financing,
Yeah.
um, for the goodwill portion. And that way the seller will know, all right, they're going to continue to get a check every month until it's paid off,
Right.
or until somebody says, all right, I can get this, paid off myself. So that's not like we wouldn't be involved with a seller financing of something like that.
Yeah, seller financing is, I mean, for the listeners, it's just basically like I'm doing seller financing on a real estate property that I'm purchasing myself. And so you negotiate the terms, you negotiate the rate, you negotiate the time, the balloon payments, even like if things can get paid off earlier or if they can't get paid off earlier. So it's a really great tool if you don't want to like necessarily go through the arduous task of answering a million questions, or like, yeah, and it's an easy way to like get it started and then come to you and say, okay, we've started it, here we are with the seller financing, now I need my balloon payment and I'm going to come to you as well. um this goodwill though, I don't understand it. So like you're saying, um whatever. So you're saying that the business, let's say we're selling a bar, right? And like I sold Ollie's bar in Warwick on what's it, West Shore Road. So in that property he had 3 units or 4 units above, a bar downstairs, and then so that's the real estate separately. But the goodwill would be like, let's say he's showing a certain amount of money coming that he's making. Are you saying that that's the goodwill part?
It could be, and especially with a bar, say it was a cash bar, so all of the money isn't shown on the books,
Yeah.
and
We're
that,
not saying that
yeah,
though.
but just as a
Yeah,
just
right.
as a just as an
Well, yeah,
example,
yeah.
and the financials for the business shows that it can support a loan, but you know that
And then what's the rate? Like, so let's say, I'm just saying, like, let's say the business cash flows, I don't know, like let's say it's $150,000. So what like percent are you typically taking of that value? Like, would you be like, okay,
that's like a CPA
that's like
question.
a CPA question and an appraiser, really. But you could say, like, as the purchaser, you're like, okay, I'm willing to pay 50 grand because I know that it's bringing in $150,000, right? Whatever you're comfortable with, whatever it is. But that's like, is that the goodwill?
Exactly, yeah.
Okay. Okay, perfect. Because I was like, I just want to totally understand this. Um, and so tell us about like some other products that you guys have and would benefit anybody who's looking to um, build, build from the ground up.
Mhm.
Um, do you have any products?
So we recently became correspondent lenders for new construction and rehab.
Mm-hmm.
That is, so generally speaking, We charge 2 points for any loan that we do.
Okay, so
That's our
2
flat
point,
rate.
so
2% of the loan amount.
Yeah, 2% of the loan amount. So let's say it's $100,000. You're gonna pay $1,000 or $2,000. Yep,
Mhm.
just for everyone who's listening.
So with the correspondent lending program, it's a rehab loan. It's a rehab or new construction.
Mm-hmm.
So if somebody was buying, they wanted to build a new construction home.
Yep.
They wanted to build a single family on
Perfect.
spec.
Mm-hmm.
If there is no permits in place, they would be looking at putting 40% down on that land. If there
On
were
the land.
on the land.
Okay.
If there was permits in place,
Okay.
they would be putting 25% down on the land. And then we would be able to get them, obviously, the rest of the money for the land financed, as well as the rehab cost.
Okay.
As long as at the end of the day, that loan is at 70% of the after repair value.
Okay.
With that, if somebody is well experienced, say they've done 3 or 4 deals in the past 2
Deals
years,
as in they've
transactions themselves in their name, they've built 4 homes, sold 4 homes in the past 2 to 3 years, then they would be looking at a 10% rate. They are paying interest only on the money that they've utilized. So, with any rehab loan, you have your rehab budget held in escrow.
Sorry, so you said 10%?
10% for a rate.
Okay. And then you only pay, so it's like a home equity line rate. So like you're only paying for what you use, right? At the moment. So
Exactly.
So let's say, for instance, fine, you purchase the land. I mean, what I would recommend is, if you, especially with land, and I would say, instead of paying the 40%, I would just take that money that I would have to put down, right? I would ask the seller to like hold paper for me. Whatever, put 10% down. In the meantime, get the surveyor, get the plans, submit, get your permits in place, then close on the land. Once you close again, you could close again. Close once you get all the permits done. I guess you could just do that in general anyway. You could just have everything get done, have the surveyor come out and get the plans done, and then close once the permits are in place. Because do you need to have like a permit in your name?
So I know that some people will prepare lots so that it is ready to build, because somebody will be able to get more money for a lot that's ready to build on, opposed to
100%.
having to get all of the work done first.
Because it takes a lot of time. And in real estate, especially in development, what I've always learned is that it's all really about timing, right?
Mhm.
So it's like the moment somebody has the money to be moving it to something else that's like immediate, great. Especially when you have crews and you're like working from here to here to here, you need to be able to be, being able to be paying people throughout that time, right, to do the work. Okay, so 2 points, 10%, 25% down if you have the permits, 40% if you don't have the permits. So get the permits in place.
If they've already owned the land, so they bought the land outright,
Yeah.
they can get a drawer at closing. So they can recover some of that money.
What is that?
So if they have permits in place, they can get up to 60% back at close. I'm sorry, if they have permits in place, they can get up to 75% of the value of that land back at closing, depending the value of the money that they paid for the land. So if they only spent $100,000 on a $200,000 lot, the lender's not going to give them the equity that they ended up getting on that lot.
Okay.
It does come directly from how much did somebody actually spend on the land.
Got it.
They want to make sure that they got skin in the game.
Right.
So if there is permits in place, they can
Okay.
get up to 70% at closing. If there are no permits in place, they can get up to 60%.
Okay, so you own the land and you're going to get back 70%? Is that like,
Because you own the land outright, so you paid that money out of pocket.
you already paid it? Wait, is this okay? Hold on. Say it again.
So if you own the land outright,
Okay.
you are able, if you have permits in place,
Okay.
to get 70%. I'm sorry, 75%
of the value
of the value
of the value.
that of what you paid. That's
So what if you only? I mean, some lots you only pay $10,000. You're getting $7
Then there's
grand.
no reason to do that. But if somebody is
Okay.
buying a larger lot, and they want to have some of that seed money to be able to get work
I
started,
mean,
because
okay.
anytime you're working on a rehab drawer, you have to get work complete. You put that money up yourself, and then you're getting reimbursed as the work is complete.
Right.
So say you put a lot of your money, a lot of you're taking away some of your own liquidity
So
in
you buy,
order to
like,
buy the
yeah, if you
land,
buy it for 100, you're just sitting on it, then you would get 70,000, and then you could, I mean, 70,000 will definitely get you started.
and then you can get your foundation done. You can start getting some framing in, and then you just continue your work. You
Mm-hmm.
continue to make your progress.
Mm-hmm.
If somebody owns a couple lots that are next door to each other,
Mm-hmm.
they could get 3 foundations done at once and do them in batches. Um, that is something that I like seeing about people who do new construction.
Yeah.
Is just how they execute their projects and how organized some people are with getting them done, well, especially when they have good crews behind them. Like when somebody's getting into new construction and rehab, we always tell them you got to have a really good contractor because that's the link to your success. If you don't have a contractor that's solid, that you can depend on, that's honest,
It's
then
gonna do what they say.
yeah,
Shocking.
then you could, if they don't, then you could have issues there. But if you have somebody that you can depend on, that you can be successful.
Yeah, I mean, I think the biggest thing too, and this is with anyone who's even working with a contractor, is to make sure that you're not giving any of the money up front, right? Because a lot of people will, make sure that you're doing like a third, a third, a third, right? Versus some people will, contractors will ask like, "Oh, let me get the rest of the money," and you're like, "No."
And that's exactly why a bank a lender doesn't give the whole rehab budget at closing because that's their only protection and know that you're going to get the project done,
Right.
and so that they can release funds as items are getting completed.
Right.
And something else that a lot of lenders will do is they'll run title again on the property to make sure there are no mechanics liens on the property so that they know that you are also paying the contractors and the money's just not just going in your pocket.
Oh, interesting. Yeah, I mean, I think working with contractors too, I mean, just a quick search, see if there's any lawsuits against them, what have you, is always like just a very important 5 minute, and it will save you
Yeah, you got to do your due diligence in every
tens of
aspect.
thousands of dollars. Yeah, yeah, yeah. Um, okay, cool. So tell me, so you're going to lend on 70% of the value of the property. So let's say the property is $1 million. You're going to give $700,000. Does that include the land? That's all included, right? The land
If the
plus.
after repair value is $1 million,
Yeah.
then the maximum loan amount would be 700,000.
Okay.
And depending on somebody's experience, that's going to that will dictate how much money they will be able to get lent. If somebody is not as experienced, say it's their first project and they're
Mm-hmm.
doing a rehab,
Mm-hmm.
then they would end up with, I'd say conservatively, I mean, they would still want to see 70% at the end of the day, but they're going to have you put down more when you purchase the property.
And that's why real estate is, especially like new construction or development, that's typically like what you want to see in terms of return, is that 30% that you're making, like right around there, because that's what you're
Exactly.
being lent on. So, I mean, that's why when I started real estate and I started this podcast, because I was working with developers and I'm like, these guys are making a lot of money, like 30% on the sale of these properties, and that's like after everything. And so then I was like, well, if these guys could do it, I could probably do it. So I started interviewing like a bunch of different
Hmm.
a bunch of different developers to just see like what their process is, what to look for, where they fell, where they fell before, and just like the things to watch out for. So but anyway, and also like that lending part, the financing part, especially when you're building, it's so important to have, obviously, first is like the sales, like how much can we actually sell this thing for
Hmm.
realistically and conservatively? Like, this is the bare minimum that we would be able to sell it for. Anything above that is gravy. Then you get the financing, which obviously you come into play. And then the construction part is that part that is very important. Um, but that's kind of like the trifecta that I see. Um, and then so when you're buying the new construction, we're um are like what else do you need it for, as the lender? Like if I were to come to you and say, okay, I want you guys to fund my new construction build, what does that process look like? And then what do you guys need?
So, I mean, compared to SBA, significantly less,
Mm.
or just bank
Can you do
financing in general.
SBA for that? No.
So not for doing flips or something like that. If you wanted to build a property for yourself,
Yeah.
so say somebody was a landscaper and they wanted to have like a contractor's garage, then
Uh,
we could do a construction loan for that, and they could build a space for themselves.
okay, that's cool.
Um, but I mean, really, it's straightforward. We need the plans. They need to be the stamped plans. We need to see the site map if it's new construction, the budget, bank statements, and credit score. That's really that's what goes into it. They're not looking at tax returns. Um, yeah, the rehabs and new construction are pretty straightforward. We do have one other program that it was 100% financing. Now I would say realistically it's 95% financing.
Okay.
That we would
Tell
you
us about that
that you do
one.
need to get pre-approved for, so they do collect bank statements because
Okay.
tax returns, because it's a private corporation that does the financing, and they just want to make sure that that borrower is strong personally, and that can close in 2 weeks, whereas if it was with like the correspondent lending program, that's between 30 and 45 days.
Mm-hmm.
Private money, hard money loans, you're still looking at 2 weeks, but they're not going to lend you as much money. So that's why we do have a few different programs for new
So this
construction.
95%, that's for new construction?
They will also do new construction as well. So for that, they won't do 95% financing
Yeah.
with the land.
Right.
That's more, the 95 would truly be for rehabs.
Okay.
Um, but it depends. I mean, it really, it depends on, there's a lot more flexibility there because you are dealing with a private corporation opposed to a
I'm
whole
sure the
publicly
interest rate has to
traded.
be higher though.
It's 12%.
Yeah.
So it's on par with hard money.
Yeah.
The correspondent, that's why we're doing the correspondent lending, is because if somebody is experienced, then we can offer them that 10% rate. And we're charging between us and the lender, they're only paying 2 points,
Right.
whereas, private
Which
financing.
is pretty, if you do go and look for private lending, you can find those rates, right? Um, but again, sometimes private lending is just a little bit easier because you don't have to do as much. However, um, to have this is all. 10%. That's great with 2 points. I think you're on par with what's out there,
Mm.
if not a little bit less, for sure. So, um, is there any like technology that you in your business like leverage that you use?
A pen and paper
I
and a
know.
calculator.
I
That's
know. And the
really,
funniest thing is that if you guys know Bill Wallace, his dad, he has a flip phone, right?
he doesn't have a flip phone
Not
anymore. He
anymore.
has an iPhone now
Oh
as
my
of
God. Well,
maybe 2 months now.
because I would call him and he must have like given me his number and he's like, nobody has this number. I'm like, this is the number you gave me. And he was like, yeah, it's my flip phone. So I'm so proud that he got his
He
iPad.
got rid of the bat
Or
phone.
I know it's kind of I've been really going back towards just like not technology because I feel like it's a distraction. So like in my house like we have like an old record player, like a record player with a CD and a radio because I hate the fact that like when you go into your phone to put on music then and I try not to have my kids. My kids are really not on tablets or anything like that at all. They're not on screens. But like my daughter really likes music,
Mhm.
but so when she's going on to Spotify, she's like, they're like have the lyrics. So she's reading it, but I'm still like, I don't like it. So we try to just stay off as much as possible. I should get a bat phone. That would be fun.
Well, I don't know. Like going the pen and paper route, I like it because it's easier for me to commit the details of deals and clients to memory. I can close, I could have worked with a client 2 or 3 years ago. I may not recognize their face because generally, I may go to the closing, but almost all the time I'm usually at the office.
Mm-hmm.
I'm either answering the phone or communicating with banks, and physically writing all of the information and the applications and everything else. I can commit that to memory, and I do know the file very well. And I am also the person who is handling the file from pre-approval to closing. So if they have any questions, I can either answer them immediately. If the bank has a question, I can get right back to them. Don't have to say, "Oh, well, let me double check this or that." And I think that it is like I do think that clients appreciate the fact that when they are either calling the office, they're reaching myself or my father. And if we're reaching out to them, they're getting the same person every time. And they
Right.
know that if they call us between 9 and 5, one of us is going to answer.
Mm-hmm.
We may both be on the phone, but then we'll give them a call right back. Like they're not waiting, hours,
Right.
days.
Right.
Um, so that's
But
something.
it is actually true. I mean, like doing anything pen to paper it is more like ingrained in your just your like your brain versus I feel like we're so distant from everything, and even like Instagram and all that stuff. It's just like it's all just I don't know, it's nothing. You're just wasting time, and there's nothing that's like committed to memory. Um how about any book that you would recommend or podcast you would recommend? Something that there was like a book that you're like, oh wow, I love this book and I would recommend it to people, or one that you're reading. Doesn't have to be about real estate.
Mm, About to get back into reading Hemingway short stories.
Oh,
Um, I'm trying to get back into writing myself.
cool.
Um, that would not be in regards to real estate at all. It's more so about food. But
So you know what I did? I joined this every other week. There's a writing like club, I guess it would be, but it's like a meetup. So if you go online and go to like meetup.com, I'm sure there is a writing club or meetup like somewhere near Warwick because it's down in Narragansett for me. But I've been writing a book for my daughter called Dear Isabella, and so they're like these little short stories. But again, I'm like, if I it for me, I really believe about like putting myself in with other people who have the same goal, right? Like in the same room. It's so obvious. However, it really like pushes like so now I'm like, okay, now I'm there every time I'm writing at least like two letters to her. So I'm getting like closer to finishing it up. And a lot of it is like well, first of all, these people, their writing is like incredible. Like some of them, I'm like, oh my God, you were a mate, like you were a literary genius, you know? Um, but it's really interesting to kind of see like how they write and it's just every time we have like a prompt. So like people like pick from this book about just like a sentence or something, and then everybody writes about it. And so, I mean, you could obviously write like whatever you wanted, but that's how they structure it. So I would definitely, if you want to write more, it's cool.
listening wise, like I don't listen to a lot of I listen to a lot of NPR. On the radio. I have a
Mhm.
radio in my basement that NPR is almost always on, or if I'm
Mhm.
working in the garden.
Mhm.
But especially with the weather getting nicer, and we are in New England.
Mhm.
If anybody's interested in gardening, I would definitely listen to the Gardening Lady on the
Oh,
weekends on NPR. She's a
cool.
wealth of knowledge, and she's based out of Cape Cod. So everything that she covers is relevant for Rhode Island as well.
That's awesome. So you garden. What are we putting in the garden this summer?
I'm gonna be planting green beans after work today.
Ooh, yum.
I'm excited about artichokes. This is gonna be the second
Wait,
year.
like how's an art where like is an artichoke? It comes like what is it?
So an artichoke is essentially the flower of the artichoke
Right?
plant.
It's like long
So
and then
you
you just cut
get
the top.
And you get a bunch. I mean, I think so. Last year was the first year, so we didn't get any artichokes off of the plant, and I had to
Mm.
dig up the roots, overwinter them in the garage. This year, we should get artichokes, and I think you can get like maybe 13 artichokes out of a plant. So the biggest one's going to be the first main artichoke. So it's kind of like with broccoli, where you get one really big head of
Mhm.
broccoli off the top. You cut that,
Mhm.
and then you have multiple smaller heads.
I love artichoke. My mom, she's Peruvian. I don't know if it's like the way we do it, but she's always like lemon and olive oil, and that's like your dip, and a little bit of salt. It's delicious.
Also excited about squash this year.
Ooh, I
I'm
don't eat a lot of squash.
You should.
I should. I mean, it's very good.
They're very good
It's
for
very
you.
good for you.
You don't have to refrigerate them when you grow them.
Right.
I think maybe a month or 6 weeks ago, we ate our last butternut squash from last year.
Whoa. Crazy. I know we're so far from everything. Like from our food that we eat. It's like really bad.
I think that goes right along with doing having. I have paper files for everyone. Like obviously we have digital files as well. That way there's no way we could do what we do without having digital files. But I do keep a paper file for everyone. I do all of the applications by hand, and we watch the transaction grow. You have to nurture the transaction just like you have to nurture a garden. And I think that it goes a lot back to, dealing with real estate is very stressful. It's inherently stressful. It doesn't matter.
What do you mean you
You can start with a deal that, you may say, well, this is very straightforward. It could be, you could be buying an industrial property,
Yeah.
and face environmental issues. It's
Yeah.
something that you should be prepared for. Going into a transaction for an industrial space, you need to know, like, yes, as the buyer, I'm gonna get a phase one environmental done, and as the seller, they should have gotten an environmental report done when they bought the property.
100%.
And if they didn't, that's why they would have to be paying for the additional phases. But you need to be prepared for it. Just like with a garden, depending on where you are, you want to be prepared for any pests, anything that could get in and hinder the prosperity of your garden. So I think that gardening and real estate go pretty hand in hand.
Yeah, like I've gotten to kind of the point where it's just like it's about slowing down a little bit and being more intentional about everything we do um and the care that we have for our clients and because you just can't do anything well in haste, you know. And so I think just getting back to that like pen and paper, that conversation, that picking up the phone, that face to face, um hands in the dirt, that's really important.
And we spend a lot of time on the phone with people where they may have, like, we focus on what somebody's vision is.
Yep.
When we start working with somebody, what are your goals? What do you see doing? What is your plan? What do you need this money for? That's
Right.
we got to know why are you borrowing this money? And we come up with a game plan for them. They may not be prepared to buy real estate or to open a business today, but could they be ready in 6 months? Could they be ready in a year?
Mm-hmm.
And we'll work with people and figure out, all right, this is the best way for you to move forward. Sometimes we get calls from people, like the big one is for restaurants. I do not want to rain on anyone's parade or um, devalue their dreams. But if somebody wants to buy a restaurant and they have no experience in the restaurant industry, they've never worked in a restaurant, but they've always had this picture in their mind's eye of opening a restaurant, I
Don't
try to
do
very
it.
delicately tell them, maybe you should try working in a restaurant first. This is an industry where I don't know if the numbers are still the same, but I'd be surprised if they weren't, where, 9 out of 10 restaurants are going to fail.
Yep.
And if you don't have that experience, you're not starting on the right foot. Like any time we're dealing with business financing, I always say there's 3 keys to a strong borrower. It's experience, credit, and liquidity. There is no limit on how quickly you can get money together. Credit, sometimes it can take a little longer to get credit brought back up to a usable level, but it's not
Impossible.
impossible. Yeah. But experience, there is no rushing experience. It takes years to get experience.
Yeah.
Um, and when I gently am trying to talk somebody out of a restaurant, or an industry that they've just, they don't have, the credentials, they don't have the footing to be able to be successful.
Yeah.
I remind them, I get paid by getting loans closed. If I
Right.
don't do a loan, I don't get paid.
Yeah.
I'll tell them, you may not want to get a loan to do this. And there are plenty of other avenues to be able to make investments or to grow.
Absolutely.
Um, but that's really the big one. There's a lot of people, I'd say probably once or twice a month. And I love working with restaurants and doing deals for restaurants. Like I used to work in the restaurant industry, and I love seeing restaurants grow and just being able to go in
But then
there.
there's like the facts, and I feel like the restaurant industry is very difficult, and it is very difficult to sell restaurants for sure. Um, and to get financing for it. However, I do have a restaurant that is for sale and they're offering seller financing. So if anybody wants to call me on that, that'd be great. So my last question is, do you have like any mantra? Like anything you say? Stand by, live by.
I mean, generally try to keep a positive outlook, you know. Just because things may not be going right today doesn't mean that tomorrow it's going to be the same. And I do believe that if you're going to do something, you should do it to the best of your ability, regardless of how you may feel about that action that you need to do. If you do it to the best of your ability, you're not going to regret it. Consistency, positivity, and getting dirt on your hands. That's really the big ones.
Getting a little dirty. I love that. How can people get in touch with you?
They can call us on our office phone. It's 401-603-3732, which they would get either my father or myself. They can find us online on Facebook and on our website, www.cornerstonecommercialcapital.com. Those are the big two. Our website, Facebook, call the office. We love talking to people. That's really, definitely call.
Awesome. Well, thank you so much for coming on the show.
Thank you for having me.
Appreciate it. And that is it for today's episode of The Landlady Listens, where we turn vision into reality. Remember that success starts in your mind before it ever shows up in your life. Keep believing, keep building, and most importantly, keep taking action. Until next time, trust the process, bet on yourself, and go create the life that you deserve. And don't forget to like, subscribe, and share this episode with somebody who needs to hear it. Thanks. Bye. That's it for today's episode of The Landlady, where we turn your vision into a reality. Remember, success starts in your mind before it ever shows up in your life. Keep believing, keep building, and more importantly, keep taking action. And until next time, trust the process, bet on yourself, and go create the life that you deserve. Don't forget to like, subscribe, and share this episode with someone who needs to hear it. Love you.